So good morning once again. It's Ogunle and brother Percy joining us. This morning we'll be starting a new standard which is on Ifrs 16, leasing. I'll first give us a background into this standard and why it is a standard that must be treated. Before this standard was introduced, it was 2016 or thereabouts, there was a way any leasing arrangement is being treated in the financial statement. You will agree with me if you recall, there are two types of leases. We have finance leases and we have operating leases. Finance leases are leases that usually are for almost the lifetime of the asset. For instance, you have an asset that has 30 years useful life. Finance leases can just take about 25 years arrangement. That is between the leaser and the leasee. The lease arrangement has 25 years life. That's a finance lease. Another characteristic of finance lease is that the residual value of the asset, usually at the end of the lease life, is almost insignificant. So it was only finance lease that was treated in the balance sheet as at that time. Only finance lease was treated in the balance sheet. All operating leases were being written off in the statement of profit or loss for the period. But when this standard was introduced, all forms of leases are now treated in the balance sheet. That is, whether it is finance lease or operating lease, every lease payment that is beyond 1 year period. If it is not short term, we understand that short term in accounting is 1 year. When it's beyond 1 year, then it is a long term, except for some other petty lease arrangement, which we shall also be learning this morning. So we'll be talking about the definitions, the various definitions that we need to have in this on this standard. The various definitions that we are going to be treating. Let me just cut some things off here, put it here, so that we have. I want it to be bold so that you can see very clearly what we are talking about. Sorry, and this also. So, lease, an arrangement whereby the lessor conveys to the lessee in return for rent the right to use an asset for an agreed period of time. That's what we call lease. The lessor gives the lessee the right to use an asset that is owned by the lessor, and lessee pays rent for the lease. That is what we call lease arrangement. First, let me explain there because you can see rent. What's the difference between rent and a lease? You are welcome, Dorothy. Let me mute your mic from that end. So first, let's understand what is the difference between a lease and a rent. Because you can see the word rent even in the definition of a lease. Rent is short-term arrangement. Rent is not binding. You can rent a hall for 1 year or 2 years and pay the 2 years rent at a time. It is short-term. It is not binding. Because after 1 year, you can terminate the arrangement and say you are not interested again. You may come and say, okay, I want to use this hall for lectures. If it is a rent arrangement, it is short term, it can be terminated as soon as the rent you paid is finished, or maybe after 1 year. But if it's a lease, if you rent a place under a lease agreement, and you sign the agreement that you will use this place for 5 years, you are paying annually. Even if you are tired of using the place after a year, you cannot terminate the arrangement. You can't say, no, I'm not interested in. You are under the obligation to pay for the 5 years, whether you like it or not. That's what makes lease arrangement different from a rent, because we rent houses and we lease houses. You can rent and pay 2 years rent, and maybe after 1 year you are tired, you can call forth for your money and say, okay, you are not interested again. Or the landlord can come up with whatever thing and say, okay, I can't allow you to stay in this place for more than 1.5 years. But when it's a lease arrangement that is signed by both the lessor and the lessee, that initial non-negotiable period is constant. Nobody can change it. 2, underlying asset. This is an asset that is the subject of a lease for which the right to use the asset has been provided by a lessor to a lessee. So we are looking at the asset under the lease arrangement in this circumstance. Simply put, it is the leased asset, the asset that is leased. 3, right of use asset. This is an asset that represents a lessee's right to an underlying asset for the lease term or period. You see, we're talking about the right of use under the account of lessee. It's an asset that represents a lessee's right. That is what it shows that the lessee has the right to use the asset. Finance lease. A lease that transfers substantially all the risks and rewards associated or incident to ownership of an asset to the lessee. That's what we call finance lease. Now, I was trying to explain it earlier on finance lease and operating lease. Is a lease that transfers substantially all the risks and rewards associated or incident to ownership of an asset to the lessee. The lessee takes charge of the asset and almost substantially all the risk and reward comes to him. Title may or may not eventually be transferred because he may not be the one to own it eventually. And then we have operating lease. A lease other than a finance lease, that's what we call operating lease because there are just 2 types. If it's not finance, it will be operating. That is a lease contract in which the lessor retains substantially all the risks and rewards associated to the leased assets. So we are trying to define different terms we'll be using in this standard as we study it so that you get familiar with them, and when we are using them, you'll not be saying what is this, what is that. Next, we have the manufacturer/dealer lessor. You can see some people manufacture, the other person is a dealer who sells. It's a situation where manufacturers or dealers offer customers the choice. They offer customers the choice of either buying or leasing an asset. Then we have sales and leaseback transaction. It's a lease arrangement for or transaction whereby an asset is sold by the vendor or owner and immediately the same asset is leased back from the buyer. This implies that immediately after the transaction, the vendor or owner becomes the lessee, while the buyer becomes the lessor. That is, I sell something to you and then I lease it back. I'm using it. So I was the owner before the sales arrangement. After the sales arrangement, I become the lessee, and you that just bought it from me, you are the lessor. Then we have the inception of the lease. This is the earlier of the date of the lease arrangement and the date of commitment by the parties to the principal provisions of the lease. When we can call the inception, the time we call the inception of the lease is which one is earlier, the day that the commitment is made by the parties or the day that the agreement is signed. That is going to be the inception. The earlier of those 2 dates is the inception of the lease. Then we have Sorry, also let me just do something here because I know some of us are using our phones, so we can see clearly what is on the screen. Let me just try to zoom this here. So that everybody can see clearly. Please, if you have any issue with the font, let me know in the chat box so that I can work on it. So the commencement of the lease term. We talked about the inception of the inception of the lease here. Now we come to the commencement of the lease term. This is the date from which the lessee is entitled to exercise his right to use the leased asset. Inception can be the same thing as commencement and can be different. Inception is when we are still making arrangement and signing the lease. And then commencement is when the lessee has possessed the asset, the underlying asset, and begins to use it. That is the date of initial recognition of the lease transaction. So it's at the commencement of the lease that the journals will be passed in the financial statement of the lessee. We'll be seeing how the transactions are done as we study this standard. Then we have the minimum lease payment. It's the amount that the lessee is required or can be required to pay over the lease term or period. The amount that the lessee is required or can be required to pay is what we call the minimum lease payment. It will exclude contingent rent, that is, if there's anything contingent arrangement inside, costs for services and taxes to be paid by and be reimbursed to the lessor. These are the things that are not part of the minimum lease payment, but includes for the lessee any amounts guaranteed by the lessee or by a party related to the lessee, while for the lessor, it will include any residual guaranteed to the lessor. So when we talk about all this explanation, they are saying is what is it that represent the payment over the lease? And we're trying to look at the conditions that make us calculate the payment. Any contingent rent, that is any rent that is arranged outside of the lease contingency, maybe it was introduced, it's not part of the minimum lease payment, but any amount guaranteed by the lessee or by a party related to it, because I rent your house under lease arrangement and I'm going to use it in the lease arrangement for 10 years. Now, there may be a guaranteed residual value that the lessor has said that is after using this house for 10 years, the value of this house must not be less than 5 million naira. So, you know that the residual value of the lease arrangement must be 5 million naira. That's what the person is saying. So, if it is below 5 million naira, then it means the lessee will pay the difference in terms of value. You will see it as we calculate it. Guaranteed residual value. Okay, this is further explained there. Is a portion or part of the residual value of the leased asset that is guaranteed by the lessee or a third party related to the lessee but not related to the lessor. See that portion guaranteed by the lessee. You can see the word guarantee used here, and you can see it repeated here. The amount that is guaranteed by the lessee that will be the value of the asset at the end of the lease arrangement. Then we have unguaranteed residual value. Unguaranteed residual value. Unguaranteed residual value is the portion of the residual value of the leased asset that was not guaranteed by the lessee or a third party related to the lessee. The portion not guaranteed, that is, the realization of the amount is doubtful to the lessor, or the amount was guaranteed only by a third party related to the lessor. Next, we have the gross investment in the lease. Is the aggregate or summation of the minimum lease payment under a finance lease and any unguaranteed residual value. That is the gross investment. It is all the money paid, the addition of the minimum payment under finance lease and any unguaranteed residual value. So if, for instance, a property is worth 30 million, you have leased the property, let's say for 15 years, and they said the value of the property should not be less than 10 million at the end of 15 years. So the value that the commitment you are going to pay, let's say the lease arrangement is now made for like 25 or let's say 30 million naira. And they said the minimum value of the house should not be less than 10 million. So that money, the arrangement of the lease, which is 30 million, and the minimum value of the property at the end of the day, all of them added together, is what we call the gross investment in the lease. So net investment in the lease is the gross investment in the lease discounted at the interest rate implicit in the lease. You will see now that is also calculated. On-hand finance income is the excess of the gross investment in the lease over the net investment in the lease. That's what we call the on-hand residual, the on-hand finance income. So we go to the contingent rent. Sorry, I have to do this because when this was done together, I was actually busy. I wasn't seeing it the way it's showing now. And I know many of us are with our phones. So I'm trying to make it bold. Pardon me for the interruption. I'm just trying to make sure that everybody sees clearly what we are studying. So we have contingent rent. Is that portion of the lease payment that is not fixed in the amount, but is based on a factor other than just the passage of time. It's not fixed in the amount of the lease, but it's based on the factor other than passage of the, e.g. percentage of sales, amount of usage, price indices, and the market rate of interest. Rate of interest may change. All those things are contingent rent. They come in. Or if it is a lease to extract some things, you lease a property to extract some things from it for that period of time. You have what we call the amount of usage, you have the price indices, all those things we did under FA. When it is an arrangement between the leaser and the leasee, maybe to extract some natural resources from a particular property. So those things that are not part of the agreement at the beginning are what we call the contingent rent. We can now have initial direct costs. These are incremental costs that are directly attributable to negotiating and arranging a lease incurred by the leaser. This is the leaser incurring this, e.g. commission, legal fees, and other costs are directly attributable to negotiating and arranging the lease. These are incremental costs that are directly attributable to negotiating. They are part of the expenses, but not directly to the lease. If you remember what we studied under relevant costing, I know some of us doing FR will still do that in our PM, and those of us who still do SFM will learn more about relevant costing. If you want to take a contract, you have gone to do the bidding, you spend money on transportation, all those expenses you incur before winning the contract are indirect costs of contract. They are usually written off in the profit or loss. They will not be capitalized as part of the cost of the contract, because whether you win the contract or not, you have incurred those expenses. So even if you don't win the contract, you can now come and capitalize what you have not won. So we call them indirect costs. So we have lease term, the non-cancelable period for which the leasee has contracted to lease the assets, together with any further terms for which the leasee has the option to continue to lease the asset. The period of lease is what we're talking about. You lease the property for 5 years, you lease the property for 10 years. That's what we call the lease term. That's what we call the so with or without further payment. When at the inception the lease of the lease it is reasonably certain that the lessee will exercise the option. That is, there are other options to extend the use of the property, and the lessee may exercise the option. For instance, you have been renting a property for 100,000 per annum, and they give you an option to extend the lease agreement for another 3 years for the rate of 70,000 per annum. Then it is certain that the lessee will want to take that because there's an incentive in the arrangement. But what if we say you have been paid initially, you pay 100,000 now for the first 5 years, and if you want to extend for the next 5 years, you'll be paying 120. Then the lessee is not necessarily going to take that option. So lease term is the period that the non-cancelable period. Don't forget I said the difference between a lease and a rent is because the agreement is binding on both the lessor and the lessee. So they use the word non-cancelable period for lease arrangement. You can't cancel it. So that is it. Interest rate implicit in the lease. This is the discount rate at the inception of the lease this is discount rate at the inception of the lease causes the aggregate present value of the minimum lease payment and the unguaranteed residual value to be equal to the sum of the fair value of the leased assets and any initial direct cost. The central bank decides the interest rate. So the interest rate as at the date, this kind of interest rate is the same thing as discount rate. As at the date when the lease agreement is made, it's usually the interest rate that is used implicit in the lease, and then over the period that the lessee will use the property. All these things you will see how they calculate them. We're just having background knowledge into the standard, so that when we start doing the computation, you will see where the computations are coming from and the purpose for calculating each data we must calculate. Then we have lessee's incremental borrowing rate of interest. This is the rate of interest the lessee would have to pay. Will have to pay on a similar lease, or the rate the lessee would have incurred to borrow the fund necessary to purchase the asset under similar terms and conditions. So we have the non-cancelable lease. Don't forget the word is popping up here again. This is a lease that is cancelable only in one of the following situations. These are things that can cause a non-cancelable lease to be cancelable: upon the occurrence of some remote contingency. That is, something happen that is not the fault of either the lessee or the lessor. You rent a property, for instance, there's natural disaster. That's a contingency, an accident. Nobody planned for it. Two, with the permission of the lessor. So we're looking at that also. This is a lease that is cancelable only with the permission of the lessor. That is, the two of them, both the lessee and the lessor, agree to cancel. If the lessee enters into a new lease for the same or an equivalent asset with the same lessor. I rent a property from you in Ondo State, and I also rent a property from you in Osun State, and we see that it's the same you that I'm dealing with. Businesses that in Ondo State is no longer working. I decided to go to Osun using your property. We can cancel the lease arrangement we have in Ondo State. That is, we have the same. It is the same lessor that leases the two properties. Upon payment by the lessee of an additional amount such that at inception, continuation of the lease is reasonably certain. That is when those a non-cancelable lease can be cancelled. So we have here the inception date, the inception date of the lease. That's what it should be. This is the earlier date. We talk about inception at the beginning, we talk about commencement, and we talk about beginning. So let's look at it. When we say inception, there's the earlier of the date of the lease agreement and the date of commitment by the parties to the principal provision of the lease. That's what we call the inception of the lease. Earlier the date of arrangement, because it's possible that we have not signed the agreement, but I've given you the property. So if I give you the property before the agreement is signed, the lease has commenced. That's how you use the word earlier of the date of agreement, that is the date of the agreement is signed, and the date of commitment by both parties to the principal provision of the lease. That is what part of what we call the inception date. Two, we have the commencement date. This is the date on which the leaseor makes the underlying asset available to the lessee. The day I hand over the property to you as the leaseor to the lessee is the date of commencement of lease. By commencement of lease, we mean the date that the lessee will open a book in respect of the lease and start posting transactions. So we have the beginning of the lease term. The lease term begins on the commencement date of the lease and includes any rent-free period provided by the lessee to the lessee by the leaseor. So that is the beginning of the lease term. When we talk about lease term, don't forget, lease term is a non-cancelable period for which the lessee has the right to use the underlying asset, which includes the period covered by an option to extend the lease if the lessee is reasonably certain to 1. Exercise the option to extend. 2. The period covered by an option to terminate the lease if the lessee is reasonably certain not to exercise the option to terminate. Those are the things we call the lease term. So let's look at example 1 in this circumstance. Example 1. Good morning, Mr. David. You are welcome. Example 1. It says Mr. P leased the property to P Square on 1st January 20X9 for 10 years. The lease term states that P Square cannot terminate the contract within the first 7 years, but can do so in the last 3 years. You can see. It is 10 years arrangement. There is non-cancelable period. You can't cancel it for 7 years, but within the 3 years, the later part, you may. Then the contract also permits P Square to extend the lease contract for additional 5 years. That is after the initial 10 years, after the first 10 years. On the other hand, the lease term permits Mr. P to terminate the contract anytime after the first 6 years. Required, determine the following independent assumptions. 1. The non-cancelable period of the lease if it is reasonably certain that the lease of Mr. P will exercise option to terminate. If you look at the question, the non-cancelable period is what? Is 7 years. That is the lease term. Look at the second sentence. The lease term states that P Square cannot terminate the contract within the first 7 years. That's a non-cancelable period. So the first question here is answered in that sentence. We are not doing calculation now. We are trying to understand what we call the non-cancelable period and the different terms we have tried to define earlier. So the non-cancelable period of the lease is 7 years for that first question. Don't forget, these are independent assumptions. We are not saying all the assumptions are put in one. So next we say lease period or term. If it is reasonably certain that the lessee, P Square, will not terminate the contract, but will definitely extend the contract for additional 5 years, then the lease period will be 15 years. That's the answer to that, please. Because it has initially, it is for 10 years, and it has option to extend, also permit period to extend the lease contract for additional 5 years. So these 5 years plus the 10 years, if he is not going to terminate, if we will not terminate, but will extend for 5 years, so the lease term will be what? 15 years. Next to that, talk about lease period or term. If it is reasonably certain that the lessee P Square will not terminate the contract, but will not extend contract for additional 5 years, then it's going to be what? The lease term will be 10 years. That is, it will not terminate in the first 7 years, but it will not extend it will not extend for additional 5 years. So the lease term will be 10 years. Finally, he said, lease period or term, if it is possible that the DCP square we terminate the contract. Yes, if you will terminate the entire contract, they gave this conclusion here. On the other hand, the lease term permits Mr. P to terminate the contract anytime. You know, this one is terminating the lease, cannot terminate the contract within 7 years, but here he said they can terminate the contract anytime after the first 6 years. So this final answer here is what? The lease period or term, if it is probable that the leasee P square will terminate the contract, then that will be 6 years. That's where the answers to those questions are. We're just trying to establish our understanding of what we call the lease term, the lease period, and how that is determined, because it affects our computation when we get there. So that's about that. Let's go to the next slide. We now have lease payments. Lease payments. These are payments made by the lessee to the lessor relating to the right to use the underlying asset or specified asset during the lease term, and it includes 1. Fixed payment, including in substance fixed payment, less any lease incentive. So if there's any fixed payment and we give you any discount as incentive, that's lease payment. 2. In addition, it includes variable lease payment that depends on an index or rate. If there's anything like variable arrangement there, it will be considered as lease payment. Next, we have the exercise price of a purchase option. If it is reasonably certain that the lessee will exercise, let me change the word there. Lessee will exercise the option to purchase. That exercise price to purchase this after leasing this property for 10 years, we will sell it to you at 3 million naira. If we look at the calculations, we will see how we determine that in calculation, and we see that it will be favorable to the lessee to buy. Then that payment is also part of this payment. Payment of penalties for terminating the lease. If it is reasonably certain that the lessee will exercise the option to terminate. So if we say, okay, the arrangement is 5 years, but if we terminate before 5 years, you're going to pay a penalty, maybe 20% of your annual lease payment. If we are sure that the lessee will terminate, then that 20% will be added to part of the lease payment. Then the residual guaranteed values, that is the value of the leased property, the underlying assets under lease after the lease arrangement, is part of the lease payment that must be calculated. So we say in substance, fixed payments are payments that are structured as variable lease payment. Structured as variable, please. Yes, of course, I will post the video. I know you are, Dorothy, you are going to the market. Well done. I will post the video after. In substance, fixed payments are payments that are structured as variable lease payment, but in substance are not variable cost. For instance, a lease payment that is only payable upon the occurrence of an event that will certainly occur during the lease period. Those are the things we call fixed payments. So let's go forward. Main features of IFRS 16. The main features of IFRS 16. You see, IFRS 16 introduces a single accounting model in the book of the lessee and requires a lessee to recognize assets and liabilities for all lease contracts. However, the lessee may take the recognition exemption if it is a low-valued lease. Now, let's see now. Low-valued lease. What we are trying to explain here is the purpose of this standard is to see how the lessee will keep the accounts in his own book in relation to the lease arrangement. Standards IFRS 16 says that he must recognize the right of use asset and also must recognize its liability because he has the right to use the asset. So the asset should be treated in his financial statement of financial position, that is balance sheet. 2, he has a liability to pay some money over the life of the lease. He must recognize liability at the same time. But they now said, however, look at it, however, the lessee may take the recognition exemption if it is a low value lease. and a short-term lease. Don't forget what we call short-term in accounting is 1 year below. Long term is when it's beyond 1 year. Low value when the amount involved in the lease is not material to the financial statement of the lease. For instance, a business entity that generates 100 million naira as revenue annually enters into a lease arrangement of 70,000 naira or even 80,000 naira. That's immaterial. It's a low valued lease. You can't expect him to go and capitalize that as a non-current asset in the financial statement. So that's what we talk about, low value, and the short term is less than 1 year. So recognition exemption of IFRS 16. IFRS 16 provided optional recognition and requires that the lease can exercise the recognition exemption and expense the lease payment if it relates to any of the following two. We talk about it here. Short-term lease, low value lease, they should be expensed during the period, not capitalized. So short-term lease, what is short-term lease? We are trying to explain what a short-term is here. This is a lease contract that is not more than 12 months. Not more than 12 months. That's short-term. The lease payment should be recognized as an expense in the period in which it is incurred. So you expense the payment if it is less than 1 year. Then we talk about low value lease. Low value lease. If the underlying asset, that is the leased item or asset in the lease contract, is of low value, then the lease payment should be recognized as an expense in the financial statement in the period. Expense in the statement of profit and loss. That's what we're trying to talk about. So let's see example here. Let's see an example of what we're talking about here. This will serve as our example 1 in today's class. Example 1. So Grace Limited is the company we are looking at here. So let me quickly change this currency because the materials I use are used internationally, and so we have foreign currency here. So on 1st January, on 1 January 2023, Grace Limited acquired telephones for its staff under a 12-month lease agreement. You can see 12 months. That's short term, 12 months. You can see the term of the lease requires an initial payment of 5,000 naira, followed by 2 payments of 10,000 on 30th June 2023 and 4,000 on December 20x3. The same 20x3 within a year. Required, show the financial statement extract for the year ended 20x3. This one is simple and direct. So let's quickly open our Excel sheet and do the needful. So we have our Excel sheet here. I know you can see it. So we are having our example 1 here. Example 1 this morning. Example 1. So this example 1 is on this short-term lease. It's on short-term lease. Short-term lease because it is 12 months. Short-term lease. Short-term lease. That's our example 1. So let me bring the question here. I like doing that these days so that when you are studying the question, you will also be seeing the solution beside it. It's important that we have that done. So let me do that quickly. Sorry. Okay, let me do it this way. Just 1 minute, please. I want to make sure I have it copied properly so that it's easier for us to treat it where we should treat it. So Grace Limited is the name of this company. On 1 January, Grace Limited acquired telephones for its staff under a 12-month lease agreement. The term of the lease require an initial payment of 5,000, followed by 2 payments of 10,000 on 30th June 2023 and 4,000 on December 2023. You can also show the financial statement extra for year ended. So this one is simple. You just say Grace Limited, we have statement of financial position, statement of profit or loss, profit or loss. So once we have that, statement of profit or loss. So once we do this, the next thing, it is simple. This is just a list that will be expensed during the period, just to be expensed. So this one doesn't really have much. So we just say lease payments. That is the acquired phone for a staff under a lease arrangement. So we just say phone rent. And how much is that? We put the amount there. Phone rent. We aggregate the amount there. How much is it? 5,004 plus 10,000. 5,000 plus 10,000 plus 4,000. That's 19,000 naira. So we just put it there. 19,000 naira. So that's because it's an expense. Therefore, we put it in negative under statement of profit or loss. So this is just this. It's a short-term lease. It's an expense. It will be done once for the period. So that's it. That's how this is done. It's as simple as this. This one is simple and direct. It's a short-term lease. We are trying to look at how short-term lease should be treated, and this is how it should be treated for the period. The entire money will be expensed because it's paid within the same 1 year. He paid the first one initially on 1st January. He paid another one on 30th June and paid the final one in December. Everything is paid within 1 year. And we are preparing financial statement for the year ended. So that is it. So let's go to the next example for us to know exactly the part we are treading. So we have second example here. Honor Limited. On 1 January 2024, you can see this is the one I'm reading now. On 1 January 2024, Honor Limited acquired small personal computers for its staff under a 2-year lease agreement. The term of the lease requires an initial payment of 10,000, followed by 2 payments of 10,000 on 31st December 2024 and 10,000 on 31st December 2025. Required show the accounting entries and the financial statement extract for the year ended 31st December 2024 and 31st December 2025. So I'll take this example also to a Excel sheet where we are going to be working on them under our example 2. I'm coming, I will show you the Excel sheet now because I know you are not seeing it already. So we coming, just 1 minute. So yes. So we have the Excel sheet here. Here we have our example 2. Example 2. Example 2. So he said, on January 1, Honorable acquired a small personal computer for his staff under 2 years lease agreement. That was in 20X4. That was when he acquired this computer, 20X4. Let me zoom it a little. I want it to be put on your screen. 20X4. That's the day the lease arrangement was made. So the term of the lease required initial payment of 10,000. That one was made on 1st January 20X4, followed by 2 payments of 10,000 on 31st December 20X4 and 10,000 on 31st December 20X5. So the arrangement, the total amount that should be paid under this lease is what is 30,000 naira, but it is going to be for 2 years arrangement. You can see. So let's look at the solution here. Then put the solutions here. The solutions. So the solution is there. So we first look at the lease payments. The lease payments. So let's look at the lease payments. Then, so let's say the lease payment, total lease payment. Total lease payment. Total lease payment. So here we have the dates. Let me put the dates here, just to first see how much he paid over the lease before we do the journals necessary. So 1st January, that is 1 January, he paid. He made a payment of how much? 10,000 naira, which was the initial payment of the lease. And on 2 payments of 30 on 31st December, 31 December 20X5. So this is 1st January 20X, that is 20X4, 20X4. And then we have, 1st January 20X4. And then we have 31st December, 31/12, 20X4. And then we have 31/12, 20X5, 20X5. These are the dates he makes payments. So the lease payments, we talk about lease payment of 10,000 here also. Another lease payment of 10,000 here also. So we can see that the total lease payment is 30,000 naira. Let me put that in perspective. Now, and this is a 2-year lease. So logically, we can see that annual lease arrangement is what? Is 15,000. So this term. So I put it here, lease term. The lease term is 2 years, 2 years, 2 years. So if the lease term is 2 years, how do we calculate the annual lease? Annual lease will now be what? The 30,000 divided by 2. Annual lease equals to the 30,000 divided by the lease term, which is 2 years. So it's going to be what? 30,000 divided by 2. We're going to have 15,000 naira annual lease. So when we are posting into our financial statement, we know which lease affects which year. So let me quickly just use this small portion here for statement of financial position. Statement of profit or loss, I should say. Don't forget, it's a short-term lease because of what? The amount is insignificant. So he said it's a small personal computer for his staff under 2 years. The time of the lease required. So this is also, we are still treating short-term lease here. It's 2 years, it's long-term, but because the amount is insignificant, it's small. How it will be treated is what we are trying to look at. So this is also going to be expense in the statement of profit or loss for the period. So statement of profit or loss. Statement of profit or loss. So what we're going to be doing is to have it for the 2 years, 20x4, 20x4, and then 20x5, 20x5, 20x4, 20x5. So let me put the Naira sign there. 20x4. So we say it can be lease payment, it can be computer lease, computer lease, and that is going to be what for each year 15,000 naira. 15,000 naira. Now, but there's an effect of this on balance sheet because the entire money paid in 20x4 is more than 15,000. You can see this was paid on 1st January 10, and that 10 was paid in 20x4, and that 10 is actually meant for 20x5 because you can see it's 15,000 naira annual lease payment. So, statement of financial position. Statement of financial position. Just because this extends beyond the payment in 1 year extends beyond the payment for that year. That's why we first did the annual allocation of payment so that we will know what has happened. So under current assets, we are going to have prepayment, and that prepayment in 20x4 is going to be what 5,000 because we paid 15. We're supposed to pay 15,000, but we have gone ahead to pay 20,000 in 20x4, and its own portion is 15. So this is prepayment for 20x4, and in 20x5 there is 0 prepayments. The prepayment is actually utilized. That is the 10,000 paid in 20x5 plus the one initially paid covered for 20x5. So this is what the financial statement will look like in the book for this arrangement. Let me put it here. So this is it. The solution for example 2 is done here for purpose of emphasis. Solution for example 2 is done in that place. You can see we calculated how much the entire lease is. The lease time is 2 years based on the question. Annual lease therefore will be 15,000. So 15,000 computer, sorry, should have put there. The 15,000 naira for each month is expense during the period for which the lease was actually meant, but then there is a prepayment of 5,000 in 20x4, which will be extended to 20x5. I hope we understand the way we treated that. So let's continue with our discussion. So we go to the next slide now. Another example is here. These are examples just to establish the understanding of what we are talking about, short-term lease. The actual complex part, which involves which IFRS 16 actually sits on, will be done after. So, example: Prosper Limited. When January 2007, Prosper Limited acquired small items of furniture for its staff under a 2-year lease agreement. The terms of the lease requires an initial payment of 2,000 naira, followed by 2 payments of 13,000 and 31 on 31st December 2007 and 21,000 on 31st December 2005. Prosper Limited prepares its financial statements every 31 March. Required: show the accounting entries on the financial statement extract and the financial statement extract for the year ended 31 March 20x7, 31 March 20x8, and 31 March 20x9. Now, this is just to test our knowledge of the accrual base of accounting, the matching concept, and cutoff. So I'll take the question to Excel for us to treat it there. What they are testing in this case is a shorthand list, but we are trying to test the accrual basis of accounting, our knowledge in that respect, and how to measure the cutoff period for end of the year account, for our end of the year account. So let me put that here. Coming. The video is paused. Why? Done. 1 minute. Let me check what's responsible for that. Okay, so let me go back to where we are. 1 minute. I see that the video was paused. Okay, the Excel sheet had an issue. 1 minute. Just let me resolve this. Let me resolve this issue quickly. The Excel ran into a problem. So what's responsible for that? Just 1 minute. I want to quickly resolve the issue with Excel. So Excel ran into a short problem. Let's see what is responsible for that. Let me open a new Excel sheet first. Okay. The computer sometimes acts up. The Excel is hanging. So do we have notes with us in that place? You know, we are in practical class. We're supposed to be writing, but I made it easier for us because I do my workings at my end here. If you can be seeing the screen at your end there, try to do something on this calculation. 1st January, while I resolve the Excel issue, 1st January was when the arrangement was made and to acquire these furniture, and the year-end account is prepared on 31st March every year. So how much is actually going to be allocated to these 3 periods, 20x7, 20x8, 20x9? Begin to figure it out. Let me quickly work on the Excel and resolve the issue it's having. Let me resolve the issue with the Excel is having. I don't know why, but whatever it is, it has to be resolved. Why the Excel is acting up. So please work something at your end. It is the cutoff that we are actually going to be working with under this circumstance. It is the cutoff we are going to be working with. We are going to be working with the cutoff. So we're trying to understand what the cutoff is and how it should be treated. Okay, that file eventually did not open. Now open a new Excel sheet here where we are going to be doing our work. Okay, so let's work with the new workbook I opened. In that workbook, I encountered the problem. So I'll bring the question here for me to treat on the screen. I'll bring the question here for us to treat it on the screen. So we have the question here now. I'm loading it. Loading the question. So this is the question we are working with. They are just trying to test our knowledge of cutoff in this question. So the lease payment, the lease arrangement was entered on January 1, 20x7. That's when they entered into the lease arrangement. So meaning that, how many years is the lease arrangement? It's for 2 years. You can see it's for 2 years lease arrangement. So let's first look at lease term. We need to understand that. Let's look at the lease term. So I put the solution here. Solution. So let's look at the lease term first. So the first thing we are looking at is the lease term. The lease term. Lease term. The lease term. So the lease term is for 2 years. And how are we going to be allocating the 2 years? Dates. It means it begins when 1st January 20x7. That's the date the lease term begins. And it will end, so commencement. And on 31 December 20x8, it will end. So it's a 2-year lease arrangement. However, the accounting year, let's have that here. So the lease term, then let's have the accounting year here. The accounting year of the company. Accounting year. The accounting year of the company is what? 31st March. So 20x7, 20x7, 20x8, 20x9, 20x9. Please let me check. Okay. 20x9. So these are the accounting years we are going to be working with, and we want to allocate these lease payments to them. So based on the accounting year, 31st March. Okay, let me just put this here. That is 31 March 20x7, and this one to 31 March, another one 31 March. So we have these three years. So what is going to be the apportionment for 31 March? How much is to be allocated to 20x7? The commencement is 1st January. The ending is 30th December. So the lease term is 2 years. Lease term is 2 years. 2 years. How much is the entire lease payment? Just like we did the other time. Lease payment. The lease payments, let's calculate how much is the entire lease payment. Let me leave a space here. So 1st January, that is 1 January 20x7, an initial deposit is made. The term requires an initial payment of 2,000. So we put 2,000 here. We want to look at how much is actually paid over the lease arrangement. Then, which other date was it? Another money paid, and 2 payments followed by 2 payments of 13,000 on 31st December 20x1. So 31st, 31, 12, 20x7. Another payment of how much? 13,000. Then on 31st December 20x, another payment of 21,000. 31, 12, 20x8. Another payment of how much? 21,000. So what is the total payment of the lease? The total payment of the lease, let me just put the Naira sign here. that I'm using is no longer there. The addition of the 3. So the total lease payment is this for 36,000. 36,000 naira is the total lease payment. 36,000 naira. Now that we have agreed on this, how much is the annual lease payment? Annual lease payment is going to be what? The total lease payment divided by the number of lease term. So annual lease payment, annual payment is going to be what? 36,000 divided by 2 years, which is the term of the lease. So annual payment is what? 18,000. So if annual payment is 18,000, how much should we put in our financial statement at this following year ends? We want to apportion this to this. So the lease term was entered into on 1st January 2007, but the financial statement was first prepared in March 2007. Therefore, annual lease payment here is going to be what? 18,000 times 3 divided by 12. 3 months out of 12 months. Because 20x7 will have 12, will have what? 18,000 allocated to its arrangement under the lease arrangement. Because it is 20x7 and 20x, so this is 7 also, and 20x8. So equally 20x7 will have 18,000, 20x8 will have 18,000. But the financial statement is prepared on 31st March. So only the 3 months of 20x7 will be considered in this year's financial statement. And this one is what? 20x7 also. Okay, this 20x9. Let me, okay, this is 20x8. X8. So after this one, how many months have been considered here? Don't forget that this 18,000 for 20x7, we are still doing 27. It's now going to times how many months remain? 9 months divided by 12 allocated to 20x7. So let me put that one here. So I'll shift this one down a little. Allocated to 20x7 for 20x7 for 20x7. Why am I saying so? 3 months has gone here, 9 months comes here. Then we are going to be having 18,000. Times how many months in 20x8? 3 divided by 9. So this is for what? For 20x8. For 20x8. So what we are trying to do here is to allocate all these payments to each month. And so another one is 18,000 times, now we have 9 over 12 remaining. It's for 20x8 also, but it's done in 20x9. 20x8. See how we have allocated it. This is for 20x7. 20x7. This 2 is for 20x7, 12 months. And this 2 is for 20x8, 12 months. 3 plus 9. 3 plus 9. But appearing in the financial statement of 20x9 is 9 months of 20x7. So let's do our financial. Let me calculate what this is. How much will be here? 18,000 times 3 divided by 12. So this is the amount that will go to March 31st, 20x9 as expense. Here we have 18,000 times 9 divided by 12. This is the amount that will go into this financial statement as expense in 20x8. In addition with this, 18,000 times 3 divided by 12. So this addition is what will go into this financial statement And this one will come here, 18,000 times 9 divided by 12. 9 divided by 12. This will come here for 20x9. You see this allocation. I hope you are following me. You see the calculations I'm doing. So let's have statement of profit or loss. Of profit or loss. That's the first thing we want to calculate. So we do for 20x9, 20x7, 20x7, 20x8, 20x9. And then we put the Naira sign there. So now what we want to do now is to allocate the expense. That is lease expense. Let me just call it lease expense. Lease expense for 20x7 that will appear in the financial statement. That is, don't forget it's 31st March. 31st March. So as at 31st March 20x7, 4,500 will appear. As at 31st March 20x8, we are going to be having 13,000 plus 4,005 appear. And as at 30, the expense that will be recorded. Okay, I'm coming. Yes, this is going to appear here because it's just 3 months. This will appear here. 18,000 is 1 year, full year. And the expense that will appear here will be what? For 31st March 20x9, it's going to be this 13,500. So this is going to be what will be in the statement of profit or loss in respect of this lease. Then we need to go to balance sheet to know what the balance sheet must look like. I'm sure you see this. This is the expense because we are matching it with number of months. As at the date of that lease to the end of the accounting year of 20x7, there are only 3 months. So that's why we are considering only 3 months lease payment. As at the date of this lease, for 20x1, as at this day, part of what in 20x, don't forget March 20, the new date begins on April 20x7 to end on 31st March 20x8 for this one. So it takes 12 months complete. And this other account we are preparing for in 20x9 will consider the lease payment that is made from April 20x8 to 31st March 20x9. We have it there. So let's have our statement of financial position. Statement of financial position. Statement of financial position. Statement of financial position is what we are having here now. So we are going to be having the 3 years there also. The 3 years there. So we have the 3 years here. So what are the transactions that will be coming into this statement of financial position? 31st March. How much is going to come here? How much have we paid in advance? Okay, so we have this as lease expense. But how much did we actually pay on 1st January? We paid 2,000. I'm sure you are following. So out of 4,005 that is meant for 20x7, the only amount paid in 20x7 is what? 2,000 naira. Therefore, there is an accrued expense here of 2,500. So first, let me have it here. Current assets. And then I will leave a space to have current liability. Current liabilities. So now for current liabilities under 20x7, there's a liability of how much that we're going to pay in the month, in the year after. We paid it on 31st year, we pay this amount on. This is the cash flow. This is how we make the payment. This is the apportionment using the matching concept, the appropriate basis of accounting. Now we want to know what is left for each year that we accounted for. Only 2,000 was paid out of 4,500. So lease liability is going to be the difference between the amount that we actually owe and the amount that we pay. 2,500 in 20x, that's in 20x7. Then let's go up to 20x8. How much was actually paid in 20x8? Because this is 20x9, sorry. How much was actually paid 31st December 20x8? We paid 13,000 naira. But as at this 31st December 20x8, this 13,000 naira we paid, we covered 2,005, which is for this year, and the remainder, and how much is supposed to be for 20x8? 18,000. But we paid 13,000. Out of the 13,000 we paid, 2,005 will go to 20x7. And how much remains? After 11,500 comes actually for this year. But we are supposed to pay 18,000 this year. I'm sure you are following what I'm doing. 2,500, which is this balance, must be discharged first out of this. So let's look at 20x payment. Apportionment of payment. Let me just do a table here. Apportionment of payments. So 20x7. It was supposed to be 2,045, but we paid 2,000. For 20x8 now, 20x8. 20x8. The cash that we paid is 13,000. 13,000. But from this 13,000, out of that, 2,005 belongs to 20x7, and how much belongs to 20x8? The rest. So let me deduct this minus 2,500 that belongs to 20x7. So we have this amount belonging to 20x8, 10,500. But we are supposed to actually pay 18,000 in 20x8. Please follow through with what I am doing. It was paid on 31st March 20x8, which is within the calendar year of 20x8. No other payment was made in 20x8 until 20x9, 31st December, which is the calendar year for 20x9. Because 31st December 20x9 is a calendar year for 20x9. 31st December 20x8 is within the calendar year. Their calendar year ends on 31st March every month. So the one paid in December 20x8 covers for the remainder of 20x7 and goes into the account of 20x8, which will end on 31st March. Okay, I'm coming. 31st March 20x7, 30th 20x8. Sorry, I'm trying to get the logic right. 31st December 20x7. This one falls under it, but this one does not even fall here because this 31st March 20x8 is beyond this year. So there is still a liability as at 20x8. The entire money is accrued because 31st March 20x8 to 31st December 20x8 is a long time. So no payment was made in 20x8. So the entire liability of 20x8 in the account, the entire liability of 20x8 is going to be the liability for that month and the one for the prior year month. The liability for that year and for the one, because we are doing this account as at 31st March. And as at 31st March 20x8, no other money has been paid. Payment was made on 31st December 20x8. Do you see? 31st December 20x8 was when payment was made. So we have a liability of 20,500 as at that date. But then in 20x9, in the financial statement the 31st December 20X9, we have been able to pay. So we'll now be deducting. So for 20X8, no payment is made. So let me go to 20X9 now. 20X9. We have agreed that no payment was made because it was 31st December and the payment was due on 31st. 18,000 was due on 31st March. Was due on 31st March, but it was not paid until 31st December. So no payment was made in the accounting year of 20X8. So 20X9, we how much was actually due on 31st December 20X9. So for accounting year of 20X9, which ended on 31st March, 13,500 was due. But how much has been paid as at that date? This money had come in. Let me paint it yellow. Only this amount has been paid. Look at it, 31st March 20X9. No money was paid on 31st March 31st December 20X9. And we have money due as at 31st March 20X9. So this is the only amount that was paid as cash outflow in 20X9. So there is a liability that is extended to 20X10. So this liability is what we're going to do here. How much is due as at that date? We have this liability outstanding plus the amount due for 20X9 minus the payment made during the period of the accounting, 13,000. So we have this liability outstanding for 20X10. So this is it. This is the financial statement extras for these accounts. I hope we get the logic. This is going to be our least liability appearing on the face of financial statement for these 3 years. So liability as at the end of 20X7 is 2,500. Liability at the end of 20X8 is 20,500. Liability at the end of 20X9, which is 31st December 20X9, is 21,000 naira. So this money was actually paid in the accounting year of 20X10, which falls under the category of 31st December 20X9. Accounting year 20X10 begins on what? 1st April 20X9 and ends on 31st March 20X10. You can see. So 31st December 20X9 falls under the accounting year of 20X10, and that was when this balance of 21,000 was paid in the following year. But the financial statement of these 3 years that we are asked to prepare will look like this exactly. This is what the financial statement will look like. Under the profit or loss, we recognize the expense. We now recognize the current liabilities that extend beyond those other years. I hope we understand what we have done. So let me just frame this here for us to see whenever we are revising using the video. The question is there and the answer is there for easy access and understanding. You can see the apportionment is technical. All you need to look at is we're looking at this date that the payment was made and the date that payment was due. Payment was due here 4,500, but payment that was made is 2,000 naira. Therefore, we have a liability of 2,500. Payment due as at this date, which is this date in the account, was how much? The 2,500 here plus the 18,000 here. The 2,500 here plus the 18,000 here is the date here. But no payment was made on the 31st December 20X8. So therefore, the payment fell under the calendar of 20X9. So we are going to deduct it only from the outstanding liability. This 21,000 remaining was actually paid in 20X10 calendar, which is on the 31st December 20X9. That's the financial statement. It's very technical. When they want to confuse people, they bring in a technical question like that. So let's go on. Let's go on in our study. So we have treated this example now. Then we move on to the next. So identifying a lease contract. An entity must identify whether a contract contains a lease or not. For a contract that contains a lease, a lease, the contract must convey the right to use. Sorry, there's a repetition here. Let me quickly remove this. For a contract that contains a lease, the contract must convey the right to control the use of an identified asset for a period of time in exchange for consideration. There must be an identified asset, you can see, for a period of time in exchange for consideration. In exchange for consideration. That is, contract must convey right to control. That is, the lessee must have the right to control the asset, the use of the asset. He must be able to decide how to use it. So from the conveyor comes from the lessor to another party, which is the lessee. That this is not the original owner of the asset. Look at the sequence of this definition. For to identify a lease contract, there's an identified asset that is going to be used for a period of time in exchange and for consideration, and the contract must convey the right to control the asset. That is, I own this asset as the lessor. I'm giving you the right to use it. You are not the original owner. The lessee is not the original owner of the asset, or does not originally have control over the asset. For a lease contract to exist, the following condition must be met. The asset subject of the lease is available. The contract conveys the right to control the use of the asset, and then we're not talking about those two things that we have mentioned here now. That is the asset and the contract that must convey the right to use the asset. Let me increase the font here also. I want you to be seen clearly at your end. So there are the two elements we want to define now. So let's look at an identified asset. The asset that is the subject of a lease contract must be specifically identified. We must be able to point to it and say, this is the asset we're talking about. Please, how did you arrive at 20,500 in 20x8? Okay, 20,500 in 20x8. The liability here is 18,000 for 20x8. But the liability of 20x7 is 2,500. The addition of these two liabilities, the 18,000 for 20x8 and the 2,500 remaining for 20x9, is what gives us 20,500 here. There is no payment made as at the end of 20x8, because end of 20x8 is 31st March 20x8, whereas the payment that was made in 20x8 was made on 31st December. So no payment was made before this date. After this initial 2,000, no payment was made before this date, 20x8. The payment was made on 31st December 20x8. So payment due as at this date is 18,000. Payment remaining in 20x7 is 2,005. The addition of the two are liabilities, current liability for 20x8. And therefore, the payment that was now made in 20x8 December falls under the calendar of 20x9, which is 13,000. That's the only thing we'll be deducting from the addition of all the liabilities remaining. It now remains current liability 20x for 20x9 31st March is 21,000, and that 21,000 was paid on 31st December 20x9. The unit was paid after this date. The payment due was 31st March, payment made on 31st December. So that is how we arrive at those figures we are seeing in that place. I hope Mr. David has got the explanation now. So let's move forward. What I was even actually showing you, you were not seeing it. The Excel was where I was saying, look at the dates, payment was due, and look at the date. This is the date payment was made, and these are the dates payments were due. So payments of this one was made before the due date. Payment of this one was made after the due date. The due date 31st March, payment date 31st December. So because it was made after the due date, it's not going to be considered under the calendar for 20x8. So the entire money due in 20x8 as at this date plus the remaining money in 20X7 is where we have at 20,500. So this payment that was made on 31st December was a part of the amount due. On 31st December 20X8 was to reduce the amount due as at this date. So the addition of the due date here, 25 here, and the 18,000 here, 13,000 was paid out of it, remaining 21,000. And that was what we paid in 31st December 20X9, which falls under 2010. If we are to do for 20X10 now, 20X10, or let me just say 20X10. Let me call 20X0 so that we don't have. Supposing we are asked to do for this year, there is no lease payment. No lease payment, there no lease liability, and no lease expense is going to be recognized under this year because the lease expires under the calendar of these 3 years. So, and there will be no liability remaining because the payment was actually made before this due date. So supposing we are asked to do account for this year now, if that was part of the question, this is how this one will look like, because the payment would have been made 31st December 20X9, and this is 31st March 20X10. The payment was made before that day. So that's what we actually did there. So let's go back to the subject of our conversation. Sorry. Subject of our conversation. So, identified assets. You must be able to identify. So the asset that is the subject of the lease contract must be specifically identified. That this will be the case if any of the conditions below are met with. The asset is explicitly specified in the contract. We know the asset in the contract. The asset is implicitly specified at the date, was implicitly specified as the time that it was made available for use. You can see it, you can feel it, or the name of the asset is written there. That's identified asset. Convey of right to control. To assess whether a contract conveys the right to control the use of identified asset for a period of time, the following should be assessed. Where the lessee or a customer must have the right to obtain substantially all economic benefits. That is the one to use it the way he likes. 2, if the lessee or the customer has the right to direct how, for what purpose the identified asset is used. So the lessor does not have a say on what the lessee does with the asset. That's the only way another way of knowing whether the right has been conveyed to the lessee. That's the only way to know whether the right, you are welcome, Mr. David. That's the only way to know whether the right to convey, the right has been conveyed to the lessee. He decides what to do with it. The lessor does not have to say, hey, no, you can't use it for this. This is what you can do here. No. That's how to know if it's a lease arrangement that has conveyed the right to control. Third one, in the relevant decision about use or predetermined, and the lessee are predetermined about the use are predetermined, and the lessee or the customer can operate the asset without the suppliers having the right to change those operating decisions or instructions. What we are saying is that the lessor does not have control, does not have a say over what the lessee does with the asset. That's one way of assessing whether it is a lease arrangement that has conveyed the rights of use to the lessee. So we have an example here to test whether a lease has conveyed the right of use, the lease arrangement. The question says ABC Transport Company entered into a 3-year contract with Cash Carries Motors Limited, under which Cash Carries Motors Limited supplies ABC Transport Company Limited with 5 luxurious buses for the purpose of interstate transport. Cash Carries Motors Limited owns the entire 5 luxurious buses specified in the contract. ABC Transport Company Limited determines the route taken for interstate transport, and the charges and eligibility for discount. You can see it was owned by Cascaris Motors Limited, but ABC Limited is the one who determines. ABC Limited determines the route the transport must go, the buses must travel, the charges and the discount he gives to his customer. If Cascaris is the one determining, okay, these buses must go from Lagos to Abuja. You can't use it from Lagos to Port Harcourt. Then it will be an agent and owner arrangement. It's going to be that ABC Limited, Transport Limited is an agent if the rights and the control remains with the owner of the property. But the right and control conveys to ABC Limited to decide where to travel and how much to charge. We now further say ABC Transport Company can choose to use the buses for purposes other than interstate. Yes, it has the right. You can use it for charter. You can decide to use it within the state. You can use it for any other purpose for that period. When the buses are not being used, they are kept at the premises of ABC Transport and cannot be retrieved by Cascaris Motors Limited unless ABC Transport defaults on payment. You see, except they cannot pay, this company that owns the cars cannot retrieve it. If the buses need to be serviced or repaired, Cascaris Limited is obliged to provide a temporary replacement. That is, now the buses are bad, they want to repair it too. It is this Cascaris Limited that will provide temporary replacement for the bus so that ABC Limited does not have any interruption in its business. As a required, determine whether the above contract is a lease contract. Yes, it's a lease contract. It conveys the right of use to ABC. ABC can decide on how much to charge. It can decide to use it for free. He can decide to use the car to travel in another direction he likes. And if the car is faulty, Cascaris has the responsibility to give him ABC Limited will repair it, but the one he has to be using while the car is repaired will be provided by the motor company. So it's a lease arrangement. That's how to answer that question. Although they will not ask us that in the exam, just for us to understand just for us to know whether we understand what a lease arrangement is. So accounting for lease transaction in the book of the lease. Don't forget I said the focus of Ifrs 16 is how the leasee should keep his record in his financial statement. So this has to do with the recognition, measurement, presentation, and relevant disclosure in respect of the lease contract in the book of the lease. When we talk about IFRS, don't forget we talk about 4 things: recognition of transaction, measurement of transaction, presentation, and relevant disclosures. So we talk about recognition first. In the statement of financial position, there has to be recognition in this. In the statement of financial position, the lease will recognize the right of use asset, that is, there is going to be an asset under the non-current liability as assets, usually under non-current assets. You can see as a non-current asset, and also recognize the present value of the amount payable to the lessor as liability, usually to be split into current and non-current asset. We've seen that done shortly. So, statement of profit or loss and other comprehensive income. In the statement of profit or loss, the lease will recognize depreciation charges. That is, lessee will be depreciating the asset he has recognized, on the right of use asset as part of operating cost. It's going to be part of expenses, and also interest cost on the lease liability as part of the finance cost. That's how it is done. So measurement of the right of use asset. This has to do with how to determine the value of the right of use assets and should be considered at both initial recognition date and subsequent to initial recognition date. At initial recognition date, while the total relevant cost of using the asset will be recognized as an asset, that is right of use asset, in the statement of financial position, that is, the lease liability should be measured at the present value of the lease, while the right of use asset should be measured at the fair value of the total relevant cost. We'll be seeing that they are explaining here how the calculation should be done. So subsequent to initial recognition, After the initial recognition, the lease will be measured at the value of the right of use asset using the cost model. Cost model, cost minus accumulated depreciation. So that's what they try to explain here. I will say lease liability. Upon initial recognition, the lease will be recognized. The lessee, will recognize the present value of the unpaid lease payment. The present value of the unpaid lease payment or installment that is outstanding balance as liability. The present value should be calculated using the interest rate implicit in the lease. Subsequent to initial recognition, more appropriate. This means that lessee will recognize the lease liability as the kind amount at the commencement date. After the initial recognition, the lessee will measure or value the lease liability using amortized cost model. You'll be learning that. You still need to learn a standard called Ifrs 9, unless another measurement model is found upon initial recognition plus lease interest cost due. So we will see how this is calculated shortly in an example. So the double entry is what we are having here. The double entry said accounting entry for the present value of the lease, debit the right of use asset, credit lease liability. That's the initial recognition. Then accounting entry for advance payment or initial deposit, debit the right of use asset for any payment made in advance, credit your bank if you have paid. So we talk about the right of use asset here. The total relevant cost of using the underlying asset, that is the lease asset at the commencement date, includes present value of the lease liability plus any amount paid by the lessee on the contract plus initial indirect cost less any incentive enjoyed by the lessee plus any cost which the lessee will incur for dismantling or removing the asset. So let's see the table, how to calculate the value of right of use asset. This is the table. So calculation of the value of the right of use asset, that is the asset we want to put in our financial statement, balance sheet. How do we arrive at the figure? Present value of the lease payment plus, that is, add advance payment that you have made, add direct cost to the arrangement of the lease, if any, if you have anyone, less any incentive that you have enjoyed. If there is any incentive, then add the present value of the future dismantling cost, if there is any. That is, you are going to dismantle the place at the end. Don't forget how we did it under IS 16 when we are calculating the future dismantling cost. You remember? Please watch the video again of IS 16. That is, you want to dismantle an asset in 5 years' time. How you must discount that amount to the present value. The addition of this minus this subtraction is what gives us the total amount that will appear in the financial statement in respect of the right of use asset. So let's quickly take this example, which is the last thing we are doing this morning. This example is on XYZ Limited. On 1st January 20X2, XYZ Limited bought a plant from Merck PLC under lease contract. The terms of the lease requires XYZ Limited to make 4 annual installments of 2 million naira each, payable at 31st December. That is, he will be paying this amount every month. Don't forget that the lease term is that he will have to pay that money for 4 years, annual installments of this amount each year. The present value of the lease agreement is this. They have discounted it to the present value, but I will show you how that is done. The implicit interest rate is 15%. Implicit interest rate is 15% per annum, and it's estimated that the plant will be economically productive for 5 years. That is, the useful life of this equipment, this asset is what is 5 years. I want to highlight that. So there's an opportunity to extend the lease term at a condition favorable to XYZ Limited. The reporting date of XYZ Limited is 31st December. You are required to show the financial statement extract of XYZ Limited over the relevant period of 4 years. Since the lease is for 4 years, we want to show the financial statement of 4 years. So let me copy this question and put it in our worksheet where we are going to be doing this solution this morning. So we have our worksheet here. So let me use this part just to copy this question, and then we'll treat the question here. So this is a question. That's going to be what example. How many examples have we done? We have done two in the other Excel sheet, and then we have this one. Okay, let's number it whichever example. So what we need to do first, they have done this for us, but they have not done it for us. They would have given us the interest rate that is implicit in the lease, which is 15,000. Don't worry, tomorrow we'll be concluding on this standard and we'll be calculating the examples that will deal with how this 5.7 million naira is arrived at, which is the lease liability. So you can see, let me take us back to the computation of the right of use assets, how it is being done, which we learned here. Look at it. Present value of the lease payment. In this case, the present value of the lease payment has been given to us as how much? 5.7 million naira. Get that? Let's go back here. Which other information is there? Advance payment or initial deposit, if any. If any. If you look at the question, you will find that it did not tell us that there is any advance payment. Can you see anything like that here? No. This is the annual installment that you must pay. No advance payment. Now we go back here. Add direct cost incurred by the lessee. In the question, you will not see any information relating to any direct cost incurred by the lessee. We go back. Less incentive enjoyed by the lessee, if any. There is no question, there is no information relating to the incentive enjoyed by the lessee in this question. Then finally, add the present value of the dismantling or the future dismantling cost. There is no future dismantling cost. So out of all this information, the only one we have is what? The present value of the lease. Therefore, when we are measuring the right of use asset, which must appear in the financial statement, we are going to be using only the information relating to this present value, which is given us here as what? 5.7 million. And the double entry upon initial recognition is what? Debit the right of use asset and credit lease liability. So we are going to be doing that now. We are going to be doing that now for us to see how the workings should be done. How the workings should be done. So the first thing, solutions. Let me put solutions here. Solutions. The first thing we are going to be doing, so let me put in the capital letter. Solution. The first thing we need to do is to do initial recognition. So initial recognition. Let's do it here. Initial recognition. Don't forget that is the first thing that starts IFRS. Inclusion of a transaction in the financial statement. Initial recognition. And so we are going to be doing what? How do we treat initial recognition? Debit, credit, debit, credit. So upon initial recognition, we debit the right of use asset, right of use asset, right of use asset. Right of use asset is going to be debited with how much? The only information we have is what? 5.7 million. So let me just round it because of space. So I'll put a naira sign here, rounded to the nearest thousand. Another naira sign here, rounded to the nearest thousand. Once we have this, so debit right of use asset with how much? 5.7 million. So 5,700 here. and credit lease liability. Lease liability with how much? 5.7 million. So this is what being the initial recognition of the lease arrangement. The initial recognition of the lease. So being the initial recognition of the lease arrangement. That's the first journal. That's the first journal that we are passing in respect of this lease arrangement. Then, once we pass the first journal, the next thing we need to do is to know how this annual payment, you can see the only figures are appearing here, how this annual payment is amortized, how the liability, because once we recognize this liability in our financial statement on the date that this lease was entered into, 1st January 2022, this liability must be amortized every year. Amortization of liability means paying it, and how much is the person paying every year? 2 million naira is what he pays everywhere. So another thing we need to do now is our amortization table. So I put it there. Amortization table. Amortization table. So our amortization table, we have opening balance, opening balance. Don't forget, amortization table is done for lease liability. It will have opening balance, then it will have the interest on the lease. Interest on the lease. Interest on the lease, then it will have the payment, lease payment, cash payment. Let me call it cash payment. The cash that the person pays, cash payment. Then it will now have the closing balance of the lease. We now have what? Closing balance of the lease liability. That's how we do amortization table. You'll be doing a lot of it under this standard. By tomorrow, you will see it. And when we get to IFRS 16, you'll know exactly what we call amortization table and now it is being used. So the date, let me have a column put here for dates, because we need to have dates. Yes. So we have the dates. So we have the dates. We have the opening balance. We have the interest on lease, and we have the cash payment, and we have the closing balance. So for the dates, for the opening balance is in naira. It's an amount of money rounded to the nearest thousand. Sorry. And that's done for the interest. So the interest is also in naira form. Interest is also in naira form. Payment and closing balance, they are in naira form. Okay, but we're told that the interest rate implicit in the lease is what? 15%. Don't forget, 15%. Let me try and bold in the 15% in the question so that you see it. 15% interest rate implicit in the lease is 15%. You can see the 15% per annum. So this interest rate can be at 15%. At 15%. Let me put that there so that we will know the basis for computing the interest rate. So as at 1st January 2022, 1 January 1 January 20x2. When the lease was arranged, this is the amortization of liability. The liability that we recognize, and that is how much? 5.7 million. So it has opening balance of 5.7 million. How much is the interest on it? It's going to be 15% of this. That's going to be the annual interest on it. So it's going to be this times 15% times 15%. That's the interest rate. You can see that's going to be the interest rate. And then the payment that the person makes annually is what? 2 million naira. So that 2 million naira will come here. 2 million naira. 2 million naira. So we'll put 2,000 because we have rounded it. 2 million naira. So what's going to be the closing balance of this lease that day? So this payment will always be injected because it's an outflow. The cash has gone out from the leasee. We are looking at the book of leasee, not leaser. We recognize the rights of real asset and the liability. Now we want to amortize its liability over the 4-year arrangement. What's going to be the closing balance? It's going to be what? Opening balance plus the interest minus this payment he made. And we have closing balance to be what? 455 in year 1. So on 1st January 20x3, that is 1 Jan 20x3, the opening balance is the closing balance for the previous year. Another 15% interest is charged on it times 15%. This times 15% is charged on it. The addition of the two minus this payment that is made annually, which is 2 million. I don't forget, he said annual installment payment that he pays is what? 2 million. Let me bold in that in the question as well so that you can see it clearly. 2 million is what he pays annual, and this is a cash payment each year. So the closing balance also will be what? Just like the calculation we made here. That is opening balance plus the interest that is charged minus the payment that is made. That's what I did here. You can be using your calculator to also follow up. How we arrive at this figure is what? This plus this minus this. So 1st January 20x4, 1 January 20x4. The closing balance for the previous year is the opening balance for this year. We are also going to be having the lease, the interest charge, that is this times the 15%, which is the interest, 15%. We get the interest, and then the 2,000 naira is also paid here. Okay, let me just copy that here. The 2,000 naira is also paid in the 3rd year, which is what he pays annually. And we are also going to be arriving at this closing balance by saying what? This plus this minus this. That's how we arrive at this. Be using your calculator to follow me. In the 4th year, which is the end of the life of the lease arrangement, 1 January 20x5 now, which is the 4th year. We have opening balance of the lease, which is was 1.7 million. The interest is also going to be what? This times 15% times 15%. That's the interest. So the payment that was actually made was also 2 million naira, which is the 4th year payment that the leasee is making. And so we arrive at this. Now, there may be a little difference here because of rounding, but let's confirm that what we have here is the same. You can see this negative 17 is supposed to be 0. 17 naira. The thing is, what we just did here is an approximation because we're trying to approximate this. So the only difference is going to be as a result of our approximation. Otherwise, the lease is supposed to be 0 at the end of the life of the lease, 0. So it means that the payment would have been discharged over the 2 years time. That is how this is computed. That is how this is computed. This is what we call amortization table. Amortization table for lease liability. So what are we going to be doing with the information in this place now? So statement of profit or loss. Let me quickly, I'll be rounding up now. Statement of profit or loss. So what the only figure for the years we are having here, 20x2, 20x2, 20x3, 20x4, 20x5. Those are the 4 years we are working on. So let me just copy the naira sign that we need for the 4 years and put it here. So what will come under profit or loss account is depreciation. Don't forget depreciation. So what's going to be the annual depreciation? Annual depreciation, let me just put that one there. Annual depreciation. Annual depreciation. We are told that the asset has how many useful life? 5 years useful life. This is the question. Let me look for it. 5 years. So let me put in that also so you can see that the asset has 5 years useful life. 5 years useful life. You can see that it's in the question. So we have recognized asset at how much? This amount. So annual depreciation is going to be what? This amount. That is this amount of the value of asset divided by 5. That's annual depreciation. So our annual depreciation is what? 1140. That will come every year. It will come every year. It will come every year. You can see the things that will go. These are the things that will go towards the balance sheet. The balance sheet. That's why the profit or loss account. Depreciation charges will come to profit or loss accounts. Then we have interest. So we call it finance cost. Finance cost. And what's going to be the finance cost? All these interest expense for each year will be put into this place. So this comes here. This comes here. This comes here. This comes here. And this comes here as interest expense. They are also supposed to be in jacket. These are the information that will affect the profit or loss account as far as this transaction is concerned. So after this, I would like to stop because I have other things to attend to. Tomorrow morning, we'll round up this question and or let me give it to you as an assignment. Do the balance sheet. What we leave doing on balance sheet? Okay, let's leave it. Let's leave it because of time. Let's leave it. I will finish with this question tomorrow morning so we can see how the balance sheet is prepared as far as it is now. I'll be doing more example of this tomorrow for all of us to have a better understanding of what we have done. So this is how lease is computed, the amortization table, the first initial available entry, what will go to statement of profit or loss over the life of the lease, and all the other calculations that we need to do. So that will be all for today. Tomorrow we will start from there, and then I hope we will complete it tomorrow. So enjoy your day. If you have any question, put it in the chat box. I will see and respond to it as appropriate later. Thank you.